Yes, I know, the dreaded word, taxes. As Ben Franklin claimed, in this world, nothing is certain except death and taxes. With tax season past us, it's the perfect time to start planning for next year's taxes. Tax is one of those things where some planning really moves the needle when it comes to saving hundreds, if not thousands of dollars. If you are saving up for a vacation, a wedding, a car, a house, you might be saving on the day-to-day things that cut down on a few dollars like eating out and transportation. But taxes can range anywhere from 20 to over 50% of your income. With that in mind, let's jump into the ways you can pay less tax and keep more money in your pockets for the things that really make an impact in your life. How taxes work. Before we jump into the ways you can save tax, you first need to understand how income tax is calculated. What tax rate applies to you? There are usually two rates of taxes you need to be aware of. In Canada, you have the federal and provincial or territorial tax rates. Similarly, in the US, you have the federal and state income tax rates. The federal tax rate applies to everyone across the country, but the provincial or territorial tax rates depend on where you specifically live in the country. Some things you need to keep in mind is that you will be subject to the combined rates of federal and provincial or territorial tax. Progressive tax rates. A common misconception is that you are subject to a flat tax rate that applies to all your income. I was actually having dinner with a friend a few weeks ago where we were talking about taxes when a lady sitting next to us chimed in that she was paying 60% tax rate. She was a successful business owner and was paying high taxes. While I did admit that tax rates are pretty high in Canada, but that 60% tax rates currently don't exist in Canada, nor is all of her income being taxed at this highest rate. In the case of Canada, you can actually see here the provinces and territories with the highest marginal tax rates that range from the lowest of 44.5% all the way up to 54.8% based on the 2022 tax rates. In Canada and most developed countries though, a progressive tax rate system is used. This means that your income is not taxed at one flat rate, but that your income is taxed in different buckets. Using BC as an example, the combined federal and provincial tax rates are 20.06% on taxable income of $45,654 or less, and then 22.70% on the portion of the taxable income over $45,654 up to $53,359, and so on. You would then add up all the taxes calculated at each income bracket to come up to your final tax liability. At a certain point, if you earn income more than $240,716, then you are considered to be in the highest tax bracket, where any income above this amount would then be taxed at the flat rate of 53.5%. I remember my tax course back in university where my tax professor said that it should be our goal in life to be in the highest tax bracket. Anyways, that leads into our next topic of marginal tax brackets. Marginal tax rates. So a quick and dirty way of calculating the tax impact of certain tax planning concepts is to know what your marginal tax rate is. Your marginal tax rate is the tax you would pay on the next dollar made, or conversely, the tax you would save on $1 of tax deductions. For example, if you make $70,000 per year and you are thinking of how much taxes you would need to set aside on a side hustle income of $10,000, you could do this quickly by knowing your marginal tax rate of 28.2%, which is the combined BC and federal tax rate, and then applying this tax rate to the $10,000, which results in additional taxes of $2,820. Alternatively, if you have a tax deduction of $10,000, you could save $2,820 of taxes. Deductions versus tax credits. I was going over the tax return for one of my clients, and on one of the tax credits, and my client was surprised that $1 of donations made didn't decrease his taxes by $1. That's not exactly how taxes work. You need to keep in mind two main ways of decreasing your taxes: tax deductions and tax credits. Tax deductions reduce your income. That means that if you have income of $70,000 and a tax deduction of $10,000, your income gets reduced to $60,000. Then you would apply the progressive tax rates, which we just mentioned, to your reduced income of $60,000 to get to your tax liability. Once your taxes are calculated, that is not the end. We would then need to calculate the tax credits. And in the case of tax credits, it reduces your taxes dollar for dollar. However, calculating tax credits requires some extra steps, which a tax software usually does the heavy lifting. For one thing, you have certain items that you would need to be considered for tax credits, such as your personal amount, which everyone gets if you're a Canadian resident, medical expenses, donations, etc. Once you add up everything, you would then apply the tax credit rate, which is then used to reduce your taxes. A quick example is the federal personal amount that everyone gets of $15,000 for 2023. You would apply the federal tax credit of 15%, which results in $2,250 of tax credits. This can now be used to reduce your total federal taxes by $2,250. Alternatively, it also means that your first $15,000 of income is not subject to federal tax. Now that you have an understanding of how taxes work, let's dive into how you can reduce it. Employees. If you are an employee, meaning that your primary source of income is your salary from a job, there are very limited tax deductions and tax credits you can get. That is because all the business expenses are incurred by the employer, who then gets all the tax benefits. The only major way to reduce your taxes as an employee are through tax deductible pension contributions, such as the RRSP in Canada or the 401k in the US. You could also get tax credits for donations made to registered charities. A less common type of deduction for employees are home office and vehicle costs. However, this depends on your arrangement with your employer, and you need a specific form called the T2200 Declaration of Conditions of Employment in Canada, which is signed by your employer in order for you to be eligible for these sort of deductions. Business. Now, the tax system favors businesses when it comes to reducing your taxes. Having your own business opens the door to far more types of expenses that you can deduct for tax. And no, you can't just have a hobby which you call a business. You need to actually have the intent to make a profit, and you need to have the evidence to support that intent. You can operate your business as a sole proprietor or a corporation. Whether which entity is right for your business depends on various factors, which you can learn more about in my video here, which I'll link, called Should I Incorporate? And contrary to popular belief, incorporation isn't always the best option. As a business, you not only have access to certain tax deductions like travel expenses, meals and entertainment, as well as big purchases such as laptops, cameras, and even cars, which reduces your taxable income. But if you incorporate, you may access the small business tax rate that can be as low as 9% up to 12.2% here in Canada. As good as it sounds, there's much more than just a low corporate tax rate. While this is great if you are reinvesting after-tax profits back into the business from the low corporate tax rates, if you plan to take money out of the corporation, either through a salary or dividend, you get taxed based on your personal tax rate. Fortunately, there are tax planning opportunities available to minimize taxes. Make sure to reach out to a tax advisor if you have a corporation, because things can get pretty complicated. And on a side note, if you are an online business, content creator, or a consultant located here in Canada, making between $100,000 to $1 million per year, and you're looking to optimize your tax situation, get in touch with us by visiting our website. Links will be provided down below in the description box. Non-taxable income. Other ways to pay less tax or even no tax at all is by taking advantage of the tax sheltered accounts that are completely legal. In fact, they are actually promoted by the government. Here in Canada, we have special accounts like the First Home Savings Account, the Tax-Free Savings Account, and the Registered Retirement Savings Plan, where you can grow your income tax-free. You can also take advantage of certain programs like the Home Buyers Plan when used properly, which can save you anywhere between $7,000 all the way up to $21,000 in personal income tax. For homeowners out there, you might be familiar with the principal residence exemption. This means that when you eventually sell your home later down the line, any capital gains that you earn from selling your principal residence is tax-free, even if it's hundreds of thousands of dollars. This may even be the case if you convert your principal residence to a rental property if you file certain elections. For business owners, you might be eligible for the lifetime capital gains exemption of $971,109 in 2023, which is adjusted for inflation every year when you sell your business after growing it for many years. So there you have it. I've given you some ways to reduce your taxes. If you're looking to learn more about the tax changes in 2023, make sure to check out my YouTube video over here. Thanks so much for watching until the very end, and I'll see you in my next video. Bye!